Hi everyone, thanks for joining. We'll just give it another minute or so for other attendees to join the session and we'll be with you very shortly. Afternoon, everyone. We'd like to extend a warm welcome to you all and thank you for joining us today for the Stockspot Advanced Investors Webinar. It's great to see so many of you here on the session and we're excited to share some of today's topic, which is winning the loser's game. My name is Hannah Hooper and I'm one of the investment advisors here at Stockspot. And with me today is Chris Breike, our Stockspot founder and CEO. Now, I know there'll be people on the line with a range of different experience. Some people might have just they might have invested for 30 years or more, or maybe just starting off their investing journey. So our tips today will be just as relevant for somebody who is starting their investment journey as it would be for someone who's been investing for the last 30 plus years. We're also going to be testing the audience's knowledge. We've got a few poll questions along the way today, so we'd encourage you to give these poll questions a go. And don't worry, we can't see your individual responses. In fact, look, Chris and I can't even see your faces. So we'd love to test the wisdom of the crowd and encourage you to participate throughout the polls. Fantastic. So we've got 4 key sessions for today. First off, Chris will be talking through Stockspot's investment philosophy and why the secret to successful investing is minimizing your investment mistakes to win the loser's game. We'll then be sharing Stockspot's performance over the last 12 months, not only for our core portfolios, but also for our sustainable portfolios. And our last session will be exploring what it's like investing with Stockspot. And we'll then run through a Q&A session at the end. So just a little bit of housekeeping to get started. Please feel free to submit any questions that you have throughout the session. We do have a Q&A section on the top right-hand side of the webinar screen. We have already had a question about, will this session be recorded? Yes, it will. So don't worry, if you do need to drop off for whatever reason, we will be circulating a recording of the session afterwards. And just a friendly reminder as well that any advice provided today is general in nature and doesn't take into account your personal or financial circumstances. Now, without further ado, I'll hand it over to Chris to introduce himself and run through today's first session on Stockspot's investment philosophy.
Thank you, Hannah, and a welcome to everyone as well for joining. Thanks for joining this webinar over probably your lunch breaks today. As Hannah's mentioned, my name's Chris Breike. I'm the founder and CEO of Stockspot. Most of you would be aware Stockspot's an online investing platform that allows people to invest into a diversified investing mix. It's a portfolio business I started back in 2014. And we now manage money for about 12,000 different clients in Australia and around $600 million or so, really for a broad range of clients, which is why we're running 2 sessions. You know, we help people who are getting started with $2,000 to invest all the way through to families investing, many millions of dollars for their family legacy. This session, though, is going to be focused, on some topics for more advanced investors. And I'm going to be sharing really the why behind our investing philosophy, because I think by understanding this, it's really important to understand the why behind, why we do it the way we do it. Now, first of all, I wanted to share a brief background on myself and how I ended up starting this business several years ago. Now, as a young kid, back in the late 90s, I got a first interest in the markets. I learned about the share market from my dad, and after school, I used to research shares in the newspaper and use some of the first online services to research companies. I found myself, learning and learning more and more. And when I was 13 years old, I entered the ASX share competition, which some of you might have entered at school or your kids, and was lucky enough to win it as a 13-year-old kid. And this Sydney Morning Herald article from the late 90s actually is an article about that. Now, when I started investing, and certainly for the first part of my investing journey as a self-directed investing, something I believe, and I think it's probably a common belief for people investing on their own, is that investing is an area where the more research you do, the more you understand it, the more you can analyze company balance sheets, know how to read the market, the better your chance of success, the better your chance of getting great returns. And that's why every day after school, I would be researching and reading and learning. Now, while I think that still may be true for a very tiny percentage of professional fund managers, what I've learned working in the industry, now for many years as both a professional fund manager at hedge funds and now at Stockspot, is that your best chance of beating the share market and doing well over the long run doesn't come from beating everyone else, but simply by not losing. And that's why the topic of today's session is actually winning the loser's game, because I believe that you do best simply by not making simple mistakes. So winning the loser's game actually channels a famous paper that was written back in 1975, and one that inspired me to start this business. It was one that was written by a person by the name of Charlie Ellis. And Charlie Ellis, at the time, was interested in market performance, but later went on to found a business that a lot of you would be aware of called Vanguard. And in this article he wrote in 1975, he, I think, created a fantastic metaphor for investing. And he explained that there are two types of games that you can play in different areas of life. A game that he called a winner's game and a game that he called a loser's game. And he said that professional tennis was a winner's game because if you look at the statistics, 80% or so of points won are won by fantastic winners. Great shots, good volleys, smashes, aces. If you watch the top professional tennis players on TV and you watch the Aussie Open, you probably see this, a lot of winning points to win the game. But then he looked at amateur tennis, and the statistics actually pointed to something quite different. Unlike professional tennis, amateurs that win tennis, and this is at badge competitions and on week-on competitions, weren't the ones that hit the most winners. They're actually the ones that hit the least unforced errors. They were the ones that were the most consistent and made the least mistakes. And this was interesting. And he likened this to investing. He basically said, look, there appears to be in investing a very small percentage of people that are able to be the winners, the guys that have all of their time dedicated to studying markets and are constantly trying to win. And even out of the professional group, this group seems to be getting smaller and smaller. However, for 99% of the population, both amateurs and a lot of professionals, it appears from the statistics that investing is more like a loser's game. And by this, he meant that by being successful in minimizing mistakes gives you the best chance of long-term success. And this is something I think that most amateur investors aren't really aware of. I certainly wasn't when I started investing, but it's become more and more apparent over time and more apparent as the competitiveness of the investing industry has become more and more competitive. As more fund managers have entered, it's been harder and harder for winners and easier to win by simply avoiding mistakes. So in this session, I'm going to be focusing on what I believe are the most significant mistakes you can avoid to beat not only most of the amateurs investing, but most of the professionals. And I think it's these mistakes that we try and avoid at Stockspot that really defines our investing philosophy here. Now, to help explain some of these common mistakes, I would love to invite everyone to participate in a bit of a quiz, which we're going to be running. So if you have a look in your little portal here, you should see a little icon that says polls on the right-hand side. If you can click on polls, you'll see the questions that are going to come up. And I'd love you all to give it a go at answering these questions, because I think these will help me explain some of the reasons behind our investing philosophy. So the first question I'd love you to all have a crack at is one about the growth of investing over time. So imagine you invested $100 in the share market almost 100 years ago in 1926. How much would that $100 be worth today? And I'd like to give you all 30 seconds to have a go at answering that question. Well, it looks like we've got a range of answers. No one's picked $1,600, which is good, because that isn't right. A range of people have picked other answers, with the most common answer being $1.6 million, although a few for the different answers. In fact, the answer to that is $1.6 million. It's really hard to imagine or hard to believe that that's how much a small amount would have grown to over time. But I think this really conveys the power of compound growth over time. So over the last 100 years or so, Australian shares via the broad index that our market follows has returned 10.9% per annum. In fact, there's been studies done that show that our market has performed better than almost all and potentially all other share markets around the world over that time. Even the US, and I know you've probably seen the US has done well recently, but Australian shares have actually had a fabulous last 100 years, 10.9% per annum. Now, by compounding 10.9% per annum over 100 years, the results are phenomenal. So I think this really helps to convey the power of being patient and focusing on the long term when it comes to investing, because it's very hard to imagine that power in the short run. But if you have the patience to allow time to do its work, then you're going to really benefit from the secret to long-term success, which is getting the access to that compounding returns. Now, you might be thinking, well, 10.9% per year sounds all right, but I mean, I know companies that have returned much more than that, and I know that there are great businesses out there that have generated much higher returns than that. There are companies like Apple and Amazon in the US, or in Australia, CSL or Commonwealth Bank, since they floated, that have done phenomenally. So in this next question, I'd love you to have a think about, well, of the whole market, and you'd probably know that there are 2,000 or 3,000 companies listed in Australia. What percentage of those companies do really well and are driving that return of $100 to 1.6 million versus the ones that aren't really doing very well and generating a return? So what percentage of all of the companies are driving that big change in wealth over time? Well, again, it looks like there's a bit of a split between a few answers, but for most of you, this is another one, the wisdom of the crowd has prevailed in. So there's been a few great studies that have been done over the last few years to understand what percentage of the actual listed company universe performs well versus poorly. And I think most people misunderstand this. They think that if you go and invest in the share market and pick a share at random, or pick one off an internet forum or through the newspaper, you've got a decent chance of a good return. When in fact, about 2/3 of companies that are listed on the market do really poorly over the long run, and you're likely to get poor returns from. And really, it's just a very small percentage of extreme winners that are driving a lot of the market return. So it's not like a lot of companies are doing well. In fact, very few companies do well, but those companies that do well do extremely well. And you can see on the very right-hand side of that chart, you can see that there's like a little blip, and that's these companies like Apple and Amazon and CSL that have had phenomenal long-term returns. There's not many of them, but they're actually the ones driving all of the market return. So I think it's fascinating that only 4% of all the companies listed drive all of the market return. And another study's been done and found it to be pretty similar, 6 or 7%. So most companies are actually duds. And what does this tell you? Well, I mean, it tells you if you can be successful in picking those winners, you're going to do phenomenally. The problem is most people aren't able to correctly identify those winners and hold onto them for the long run. And so even if you had correctly identified, let's say, Amazon back in 1999, in 2000, Amazon share price fell 96%, and most people wouldn't have been able to continue to hold an investment, through that time horizon. Now, most fund managers will tell you that they focus on eliminating losers from their portfolio, and while that adds a little bit of value, what this really shows you is that it's not so much eliminating losers, but making absolutely certain that you own the winners that's most important. And that's why we at Stockspot really believe that owning the entire market index is the way to go, because only by owning the entire market index are you absolutely guaranteed to own those winners. And the cost of not owning them is so significant that really you want to maximize your potential of having those winners in your portfolio for the long run. And that's why we believe spreading your money across the whole market is a proven way of owning those extreme winners. Now, you might think, okay, well, that's great. Then I can just invest in shares because it's a great long-term asset class, and I can spread my money across the whole market, and that's going to give me a good long-term return of 10% per year. I think something that people may also not consider that much when they invest is the level of ups and downs you basically have to wear in order to access that great long-term return. So this is a question around how often there's a big market fall. So a market fall of 10%, is something we've already experienced this year. We've seen it over the first couple of months, but I'd love to know how often you think a fall of 10% happens within a year in the share market. Looks like lots of answers coming in here, and maybe a bit more of a split in the answers on this one. Evenly split between 1 in every 2 years, a 10% fall, versus 1 in every 8 years. Now, it might be true that a end-of-year return of minus 10% happens less frequently, but actually a 10% fall at some point during the year happens over 50% of the time. So if you're investing almost over 1 in 2 years, you should expect at some point in the year for the share market to fall by 10% or more. So we looked at the Australian share market, and in the last 35 years, 20 of those 35 have included a 10% fall. And many of those falls, as a lot of you would be aware, were much larger. So in the financial crisis, our market fell by 50%. Even in 2020, it fell by 35%. One of the reasons why it's difficult to access that long-term great return of 10.9% in Australian shares is that you have to wear huge drawdowns along the way sometimes. And this is why at Stockspot, we recommend not just owning all of your portfolio in Australian shares, but actually diversifying it not only within the index, but across different markets and across different asset classes, because this is what helps to smooth your returns and reduces the regularity of these big 10% falls. So at Stockspot, one of the things we do is make sure that you're not invested just in Australian shares, but you have access to global shares, both developed big markets as well as emerging markets. But I would say even more importantly than that, you own an allocation to defensive assets like bonds and gold. And what they do is they help to cushion your portfolio when there are these big drawdown years. So this chart here gives you two examples, the financial crisis back in 07 to 09, and then the big COVID pandemic market fall of early 2020. In those periods, assets like Australian shares, and property and infrastructure had huge falls in value. But if you owned a little bit of defensive assets like bonds and gold, it really helped to mute those falls and help to keep people confidently invested. And that's something we saw, is that people that had too much risk in those periods of time were often the people that made the wrong decision to sell at the bottom. They couldn't take any pain any longer. And if you see your portfolios down 35% plus, it's really difficult to keep a steady hand and stay invested. Whereas if you do have some of these defensive assets, and rather than seeing a 35% fall, you might see in our portfolios did fall during that period, but only by 8 to 17%. It's a bit more palatable and also gives the opportunity to make it back quicker. And that's what we saw. Not only were the falls smaller, but you were back above your highest level much quicker. And this is why we recommend not just investing into high risk assets. Even if you're a long-term investor, we think there's some value of having some bonds and gold in your portfolio, because market falls happen pretty frequently. Now, you might think then, well, I might not be able to pick when the market's going to be hot or cold, but there's a whole group of professionals out there that are studying the market. They're out there explaining why they think the market's overvalued or undervalued, and seem to say they know when to predict when markets are going to be falling or not. So this is a question of how successful fund managers are in actually making those decisions. So looking at the cohort of professional fund managers investing in Australian shares, how many of those were able to, through their skill of market timing and picking the right stocks, outperform the market over the last 15 years. Well, the answers to this one look a little bit more one-sided, which is great to see because most of you have got this one right. Actually, the data from S&P, who does a big analysis every year, finds that over long periods of time, whether it's 10, 15, 20 or 30 years, only about 15% of professional fund managers in Australia have beaten the market after their costs are accounted for. And this isn't just in Australia, it's in most developed markets. The reason for this is simple. One, there's a lot of competition now. Back in the 1970s and 80s, there weren't too many fund managers. And so fund managers were able to outsmart all of the non-professional fund managers out there. But these days, actually 95% of the trading that happens in the share market is just professionals trading against each other. And so you've got professionals against professionals, and therefore it's become less of a matter of how skillful they are absolutely, how smart they are, how well they've studied finance and understand how to value companies, but more a game of relative skill. And this is why fund managers on average now do quite poorly, because mathematically they have to do poorly. The whole market is just fund managers betting against each other. And for every winner, there has to be a loser. The problem for you as the end client is that you pay professional fund managers a juicy fee to access their skills, even if they don't have those skills. And that fee compounds over time. So this chart looks at the impact on your balance of paying a 2.5% fee to a fund manager, which isn't uncommon if you're paying an active fund on a platform with an advisor in Australia these days over the long run. Interestingly, over a 65-year period, so over a lifetime, if you're paying 2.5% per year in fees to a fund manager, 75% of your potential gains ends up with the fund manager rather than you, which I think most people don't really understand. If you think you're only paying a couple of percent per year, it's hard to visualize that that's going to add up. But actually it means there's a situation where you've left most of your potential gains in the pockets of the fund manager rather than your own. And actually a recent study I saw in the US showed this in a different way. They looked at hedge funds, which is a more expensive way of investing with fund managers that charge a fee of 2% per year plus 20% performance fee. And what they found is, on average, it takes 17 years for the fund manager to have more money than you, which I think is quite scary when you think of it, but really explains why the funds management industry does so well for the industry, but not so well for the end client. And this has been something that's been documented for many, many generations. In fact, a fantastic book from the 1920s that's worth a read and a good laugh is a book called Where Are All the Customers' Yachts, which basically looks at exactly this. The fact that fund managers seem to do very well out of markets, but the end customers aren't the ones that end up being able to afford a yacht. It's just the people managing their money. So in our view at Stockspot, paying less for professional fund managers to pick stocks and time the market is what's going to set you up for long-term success. Now, final question before I hand over to Hannah for the next session is really thinking about when is the best time to invest. A common question we get from clients is, when should I start investing? The market often seems high, or they'll see people that say it's overvalued. They want to wait for a pullback. I think it's a natural thing to want. When you go shopping, you want a discount, you want to buy when things are on sale. And so, is it worth waiting for a sale to happen, or should you just, buy all the time, or does it not really matter? Well, this one seems very one-sided, which is great because it is the right answer. In fact, although it might surprise you, we've looked at whether buying at all-time highs really gives you a different return to not buying at all-time highs. And what we see is that buying at market highs or not at highs doesn't really impact your results. So if we looked at every time over the last 30 or so years, and if you'd only bought when the market was an all-time high, your next 12-month return was actually quite similar to all those times that you weren't buying an all-time high, which to me says that timing the market is extremely difficult. You can then wait for a sale and hope that the market falls, but if you're if you're unlucky and it doesn't fall, you may struggle to buy higher because you're anchored to that lower point. And we actually saw something different in March 2020. We saw a lot of our clients that had some cash on the sidelines and were waiting for a market fall and were right. They were cheering, saying, hurrah, the market's fallen 30%. I was right to keep my money in cash. The problem we saw there was a lot of them then thought the market was going to fall further. And they said, look, I'll start investing when the market's fallen 40% or 50% because things seem pretty dire. And that never happened. And by the time they actually started to invest, markets had already gone up a lot further. And in some cases were actually higher than they started off. So in order to correctly time when to buy market dips, you have to make a couple of decisions, right? You have to work out when to get out, but also just as important is when to get back in again. And that, from our experience, and certainly a lot of the research, is very difficult to do. You might be right and the market might dip, but if you were waiting for a 10% dip and it only falls 5%, you've got to essentially work out some way of getting back in. Otherwise, you can be uninvested or not invested for a long period of time. So, in summary, what I would say is that unlike I think a lot of other areas of life, where you experience better results from putting in more effort, investing counterintuitively isn't one of these areas anymore. In fact, in most cases, by doing less, you're going to get better results and you're going to be able to beat most other professional fund managers. So at Stockspot, our philosophy is to make sure you're well diversified because no one really knows which asset's going to do well or poorly next year, to keep your costs quite low because that's what's going to earn you more in your pocket over the long run, to be disciplined to stay with your strategy because there's going to always be a lot of temptations to invest in something else, whether it's a sector that's doing well, a new asset like cryptocurrency. The temptations are always there, but you need the discipline to say no and just keep on going with your strategy. But if you can get all of those things right, the rewards are fantastic. And we've seen it over the last 8 years with our clients. We don't actively try and beat all of the other fund managers out there. We actually say that we're not trying to beat the other fund managers. We're just trying to help our clients reduce mistakes. But simply by reducing mistakes in this way, the results show that most of our clients have significantly outperformed active fund managers and people more actively investing out there. And we often publish the data on this, but at least over the last 5 years, it's been quite obvious. It's been outperforming something like 97% plus of fund managers simply by avoiding mistakes. So I'll leave it there. That's the why behind our investing philosophy. In the next session, Hannah's going to be sharing a bit about how this has actually translated to real life returns and results. I look forward to speaking to some of you and answering your questions later on.
Thanks, Chris. That was great. As Chris has discussed already, our investment philosophy. Now, the next session will be essentially how that translates into our performance and our results for clients. And I think it's also important to highlight the inherent nature of having a diversified portfolio. What it means is that we're not setting out to be the best performing investment manager every year. Instead, what we're aiming for is consistency and avoiding big losses, which could wipe out your portfolios when the markets fall. Which leads us into our model portfolios and how they've fared over the last 12 months from December 2021. Our returns over the last 12 months from the month of December have ranged from around 3.5% in our conservative portfolios up to around 10% for our high growth portfolios. And this is roughly consistent with our long-term results. What you can also notice here is that the 1-year performance is slightly less than that of our 3-year returns. Now, this is mainly due to the fact that we haven't seen as much share market growth over the last 12 months compared to the strong market returns we had in 2019 and 2020, just after the COVID-19 share market crash. If we have a look at Australian shares, they've been one of the best performers with 17% returns over the year. And that's just behind global markets, which returned about 33%. This was primarily driven by a really strong performance in the US, which makes up most of the exposure in the global shares ETF at around 70%. Emerging markets have had a slightly positive return, with countries like Russia up about 27%, Taiwan also up about 25%. That said, the main dampener on returns or performance have been from countries like Brazil, which was down around 20%, and China down around 15%. You're probably familiar with the collapse of Evergrande in China, which caused a large sell-off essentially in the real estate sector. And we also saw increased regulation in China around the technology sector in 2021, which has had a slight drag on the emerging markets performance. Bonds are down around 3% for the year, which has been caused by essentially the gradual easing in monetary and government stimulus around the world, as well as anticipating an interest rate hike. Now, it's no surprise, gold has returned just under 1%, but given there's been less demand for gold over the last 12 months, we've had really strong share market performance since COVID. So we haven't seen gold perform as well, but that's as to be expected given its defensive nature within the portfolio. So what does this show us? Well, it shows us that the different markets and asset classes within our portfolios have a wide range of returns. And these returns are changing all the time. This is why at Stockspot, we don't try to pick the winners, but instead we ensure that you have a range of different investments to set you up for the best chance of success. Now, onto our sustainable portfolios. We created the sustainable portfolios around 18 months ago. We've seen a lot of demand from our clients for a more ethically based approach to investing. Our sustainable portfolios ranged from around 7% up to about 15% over 12 months from December 2021. Now, a fairly common question I'm asked by clients is, will the sustainable or the model portfolios outperform each other over the long term? Which is the best portfolio for the best returns? And when I speak to clients about this, I explain that whilst returns over the long run are likely to be similar, there will be periods where our sustainable portfolios outperform our model portfolios and vice versa. Now, this is purely an outcome of the different sector and market compositions within each portfolio. So a good example of this is in our sustainable portfolios, they've slightly outperformed over the last 12 months. And that's really due to their slightly higher allocation to sectors like technology and healthcare. Whereas just after COVID-19, a lot of the beneficiaries of COVID were sectors like financials, resources, and energy sectors. So we actually saw our model portfolios outperform slightly due to their higher allocation to these sectors and industries. So look, what's the takeout from this? Well, I think the key takeout is that there will be periods where the different portfolios will outperform each other. And that's why whenever I'm speaking to my clients about, investing sustainably or in the model portfolios, we recommend that your, decision should be really based on an approach, that aligns to your values and your ethics, as opposed to purely focusing on returns. So now what you can see here is a visual representation of $10,000 invested in each of our model portfolios since 2013. And whilst to date we have had positive annual returns in all of the portfolios since inceptions, there have certainly been periods of market volatility, which you can see on this graph. And I think probably the most recent and memorable one would have been the COVID-19 market crash in March 2020. Now, I don't think anyone would have predicted that we would have had a global pandemic in 2020. It would have caused share markets around the world to fall, 35+% in some cases. And I do think this is a really good example to show that, we cannot control what happens in the markets. What we can control, though, is minimizing the amount of risk in your portfolio and making sure that you're set up for all types of different market conditions through diversification. And look, we spoke to many clients in March 2020, and look, the key theme was people were very fearful, no doubt, but they were actually really thankful to be owning assets like gold and bonds in the portfolio, which really helped to provide some strong downside protection. In fact, our portfolios actually fell they fell by 50 to 80% less than the actual share market in March 2020 because we had gold and bonds in the portfolio, which helped to smooth out the returns and cushion that market fall. It also meant our portfolios took less time to recover. So the ASX, I think it took around 44 weeks on average to recover from its highs from that drawdown in March, whereas our portfolios on average took only about 30 weeks. So a much faster recovery as well. And I think this is just a great example of how Stockspot has helped our clients provide more consistent and, smoother returns along the way. So this leads me into our next topic. What is it like investing with Stockspot? Now, sometimes I get asked by clients if it's just as easy as owning, a bunch of diversified ETFs, and why can't I do this myself? Now, of course you can. You can manage an investment portfolio, manage your own ETFs. However, there is a lot of time and effort involved, not to mention the common investing mistakes that a lot of people make by letting their emotions get in the way of making rational decisions. So Stockspot actually helps you to automate the investment process. It allows you to save time, reduce risk, and essentially makes the investment process a lot more hands-off for you. We firstly ensure that you're in the right strategy for your investment profile. So this entails, understanding your investment time frame, what your goals are, your experience, your risk capacity, and we will then construct an optimal asset mix to make sure that this is really aligned to your goals, to give you the best chance of success over the long run. We also research all the best ETFs in the market. Now, there's over 200 of them, so it can be quite an overwhelming process if you're managing that yourself. We take care of that for you. We also look after the dividend reinvestments, which helps actually to rebalance the portfolio when we allocate distributions back into your Stockspot portfolio. And on the topic of rebalancing, now rebalancing is probably one of the most important jobs that Stockspot has. And it helps to reduce the risk in the portfolio and also to lock in extra returns. So selling some of what's doing well and buying what's falling behind might sound simple, but to actually figure out exactly how much you should be buying and selling, when to do it, and what to actually be buying and selling is really tricky. So Stockspot uses its smart algorithms to automate this process, and it ensures that you're not too overweight or underweight in the portfolio at any given time. We also make tax time really easy. We generate your nice one-pager investment summary, and that avoids you having to do all the complex tax calculations yourself. Now, Stockspot's dashboard and app, look, it's really an extension of our investment philosophy. We've designed it in a way so it can make things simple, transparent, accessible, and safe. So you've got features in the dashboard, such as the performance and details section. This is where you can track your portfolio performance and the investment breakdown and asset allocation. You can also see what your next investment is and keep track of your goals and also any upcoming distributions. So we've got lots of different functionality to make things transparent and a lot easier for you. Now, one of our jobs as your advisor is also to conduct an annual review with all of our clients each year. And this is something that you can actually complete through your dashboard. That makes sure that you're on track. And if you have had any changes in your circumstances, we'll be able to let you know whether or not your portfolio strategy is still suitable for you or not. Now, Stockspot also keeps your investments safe by having two-factor authentication for any withdrawals or changing account details. And very importantly, you can also find your HIN number, your holder identification number, in the dashboard. And this number essentially means that you're the legal and beneficial owner of your investments, and that's registered with the ASX. And it's the safest way to own your investments. One of the other features that we provide all of our clients with, and those who aren't clients, is free educational content. So each year we produce the annual ETF report and our Fat Cats Fund report, and that calls out some of the best and the worst performing super funds each year. And finally, we're always accessible. So, if you do have any questions along the way, you can reach out to our client care and advice team and our team of advisors who are only a phone call or email away. Wonderful. So that includes our session for today. And now Chris and I will address any questions that you may have. We encourage you to post your questions as well in the Q&A section if you haven't done so already. Now, we'll also endeavour to get through as many of these questions as possible. If we can't get to them all, though, we will send or we'll follow up with you directly afterwards and answer any questions we can't get to.
Thanks, Hannah. I might take the first question. So there looks like there's a few questions in the Q&A, and if anyone else has others, please put them in there, and a few private ones as well. One of the questions is, what would you suggest for some of the funds like ARK Invest who are very bullish on innovation? So for those who haven't come across the ARK fund before, it's a ETF listed in the US, so it's not available in Australia, but it was one that got a lot of attention probably 18 months ago because it had such phenomenal performance over a period of a few years. It was a fund that correctly identified some of these sectors like, electric vehicles and other innovative sectors that perform very well. And so owned Tesla and some of these other companies and had fantastic returns over a period of a few years. And as a result, a lot of funds were flowing into this ETF. So actually at the peak early last year, I think there was more money going into this ARK ETF even than all of BlackRock's products, and BlackRock's one of the biggest fund managers in the world. So there was a lot of interest there. Our view on more thematic or, very focused funds like this one, and this is actually an active ETF, is that, look, with all of investing, I think the successful funds or what's going to happen in the future is only ever really obvious in retrospect. And to me, this is quite clear because before ARK had fantastic performance, there weren't actually a lot of assets in this fund. And actually the growth in the assets of this ARK fund followed the performance. And this tends to happen is a lot of money chases funds or sectors or stocks that do really well. And usually they chase them at the wrong time. And this is what happened with ARK, is a lot of money came into it after all of these stocks that had done well during the lockdowns peaked. And actually over the last 6 months or so, that fund has fallen by 60%. And so unfortunately for the average person who invested in that fund, who did so 6 or 12 months ago, they've lost money, even though it's got a great long-term track record. So, our view is that it's very difficult to pick funds and stocks. And look, even if this fund is correct over the long run and has picked some good companies, it's also a question of how correctly they've been priced in the market. And it could be Tesla's a brilliant company, but is now correctly priced. And so that fund may not perform well in the future. Our approach isn't to try and pick the next successful stock or the next successful sector. What I think is great about is in an indexing approach is that naturally happens within an index over time. So as a sector or stock becomes more successful, it will grow within an index and become a larger weight. And this is why you see companies like Apple now, having the largest weight in global stock indices, or CSL or Commonwealth Bank having great large part of our market. Success basically leads to you naturally investing more in these companies, but you don't have to bet on small companies before they become successful. So we think an all market index approach is a better way of basically accepting that the future is very hard to predict, but you want to get access to whatever sector it is that performs well in the future. I think one of the good examples is if you look at the composition of the market index 100 or 150 years ago, it was railroads that was the biggest part of the share market index. Now, obviously, if you continue to only invest into railroads because they were doing very well in the 1900s, it wouldn't have been a great investment strategy. And so you need your strategy to evolve and, allow for the fact that the market is very hard to predict, and you want access to whatever it is that is driving the economy at any point in time. And we think indexing does provide that. So that was one question. Another one I'll quickly answer was, would you consider investing into cryptocurrency ETFs? It is a question we get quite often, and not just now. I wrote the first few blogs on cryptocurrency on the Stockspot blog back in 2017 and 18 when the price of Bitcoin had one of its earlier run-ups. Look, at my perspective, probably isn't very different from then. It's an interesting asset class that I think more people are investing into. Do you need it in your portfolio? Absolutely not. I think you can earn great long-term returns without it. If you are investing into it, though, you really have to be thinking about it from a risk perspective. And I'll share either on the chat or later on a blog I've written about how I think about any speculative asset in a portfolio to make sure that you have the ability to earn the long-term returns without capitulating when things fall. Because what we do know about cryptocurrency is that there have been periods of 80% falls, and it will probably happen again. And so if you want to enjoy the long-term success of this asset class, if you believe it will be successful, you have to make sure you have a position size in it that's going to allow you to continue to stay invested even when there's big periods of volatility. And so that's the way we would look at it, is make sure that if you are investing in it, that you can benefit from your long-term view without being in the unfortunate position of having to sell when you don't want to. Hannah, I might hand over to you to answer a couple more.
Yeah, absolutely. Thanks, Chris. So I'll take this question we've got. So does Stockspot take any action to mitigate market corrections? For example, changing portfolio allocations, irregular rebalancing, or are we completely hands-off? So that's a really good question. In terms of what Stockspot does when there are any drastic market movements, and a great example is, as we've discussed a little bit earlier in the presentation, March 2020, we certainly do take action, and the main action that Stockspot would be taking would be rebalancing clients' portfolios when it's necessary. So that rebalancing piece is really important. It allows us to be able to quickly act on if your portfolio has moved too far from its target weightings. That's very important for managing risk in the portfolio, but one of the other great outcomes is that it can actually help to lock in some extra return. We had to rebalance on average twice in 2020 for our clients because there were, such drastic swings in the markets. And just from that alone, we locked in on average about 1 to 2% extra in returns just from that rebalancing piece. So our smart algorithms are working in the background every single day, looking at your portfolio, looking at what the market's doing. And if there is a rebalance that's triggered, that will be certainly, something that is acted on very quickly. As we discussed, it's actually something that's very hard to do if you are managing your own portfolio. And I think the other part to that was around changing portfolio allocations. Now, in terms of changing our actual asset allocations and portfolio allocations, it's probably something we're less likely to do off the back of, a market correction or a market crash. What we would be typically looking at to justify a change in our asset allocation is probably more to do with the correlation between the different assets and markets within your portfolio. And really what that means is you want your portfolio to have different investments that perform well in different market conditions. So when shares go up, for example, traditionally, gold may be sort of more stagnant or even down. But conversely, if the share markets fall, that's when you really see the benefit of gold and bonds increase. And I think a really good example actually is early in 2021, we actually did change some of our asset allocations in the portfolios. An example of that was that we reduced some of the exposure to government bonds. And that was because we started to see the correlation change between bonds and shares. So they were starting to move more positively in the same direction. So we reduced that allocation and we allocated it to areas like emerging markets and gold in the portfolio. To answer your question, something we're always looking at, and that would probably be more of a reason to justify a change in the portfolio allocations. I will also talk to, I believe we've got a question that's come through around the sustainable portfolios and what percentage of our clientele is invested in ethical or sustainable portfolios. So I believe it's around 15% of our clients would be looking at signing up with sustainable portfolios. That said, we've only had our sustainable portfolios for the last 18 months. But we are definitely seeing that as a trend, and we do believe that will, continue to play out. There's so much more of a focus nowadays on investing for, social, environmental, and positive governance. So that's something that we're definitely seeing as a trend. Yeah, Chris, I might hand it back over to you to answer any other questions.
Thanks, Hannah. I don't think there's too many more. There's one more I can see just around tips for SMSF investors getting good results out of the Stockspot platform. Again, I'm happy to share some videos and some blog articles we've written after this session to you on exactly some of the options we have for SMSFs. What we tend to see with SMSFs is that they may own some investments outside of Stockspot, so they want a bit more control about what they're invested into. And that's why we allow for some of these clients to change what we call the themes within the portfolio. So typically, some SMSFs might already own some Australian shares that they've held for a long time. They don't really want to sell them because they're sitting on big capital gains and they don't want to, basically have to lock in those gains. And so you're able to add more global shares or other parts of the market into your portfolio to help to balance your overall portfolio. So we see that as a common trend with SMSFs. The rebalancing strategy is also something SMSFs might take advantage of. If they don't want to be rebalancing as frequently, or if they don't mind, that may allow them to have a bit more fine tuning of their rebalancing strategy. And then the other trend we see a bit more with SMSFs, and my parents are even a good example, is they are looking for a bit more income. And so SMSF investors, particularly if they're in the drawdown sort of pension stage, are looking for a way to make sure that their portfolio is generating both some capital returns as well as dividends. Now, our portfolios at the moment generate around about 2.5% a year per dividends. I mean, it sounds pretty low these days, and it is pretty low. And that comes from, I guess, the combination of the Australian share market producing something like a 4% dividend. With franking credits, it's a little higher. And then the defensive assets are producing a bit less, and the blend of those gets to 2.5. Look, there are ways you can increase the income return a little bit, and we offer a few themes like dividend shares and Australian large cap shares that typically have higher dividend ratios. However, we would caveat that always by saying income is just one component of return. You've got the capital return and the income, and in a world of very low interest rates, you're always going to expect the income return to be a little bit lower. And it's not a bad thing to take some income return and sell some of the capital each year if you need to meet your income requirements as well. And so we can also help clients work on a blended strategy where they might take 2.5% or 3% of income, but if they need to get that to 5%, they can also sell down a little bit of their portfolio. And that doesn't mean the portfolio is going backwards because, as Hannah showed earlier, on average, the portfolios are producing a positive capital return each year. So, if the capital return part of your portfolio is 6% per year, it's all right to take 2 of that 6 off the table and you'll still see some growth. So we try and reframe our clients thinking about income and just say, look, you can take some of the dividend income, but also don't be afraid to sell down a little bit of the capital. Over the long run, it shouldn't really matter, what you take from each. So I think that's all the questions we've got here. I'm absolutely happy to answer any other questions you have via email. The Stockspot email address is on the contact page of our website. It's inquiries@Stockspot, and Hannah and the rest of the team are often available to chat as well. Hannah, I might hand back just to you to wrap up the session. And from my perspective, thank you everyone for joining today. We really appreciated your lunchtime and hope we've helped answer some of your questions.
Thanks, Chris. And yes, thank you for everyone for joining today. We hope you got a lot out of today's session. As Chris mentioned, feel free to reach out to our client care team. The details are on our Contact Us page on the website. And we will be, as I mentioned earlier, circulating a recording of the session and also a survey with some feedback. So please feel free to share, how you found the session today and anything you'd like to hear going forward from these types of webinars. We'll leave you all to the rest of your day. Thank you again for joining and talk to you all soon.